Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. And Chase, I'm just thinking, he says 27 years. I realized started in 1995. It's now 30 years. We got to update that. Yeah, it's been quite a while. But let's talk about, we got some great things to talk about today as usual. Who doesn't know about gold surpassing $4,000 an ounce? Will it hit $5,000 an ounce? We'll talk about that. And great news, more working class Americans than ever before are in the stock market. Is that good news? There's a question mark there. We'll discuss that. And lower-end consumers are having a hard time making their car payments. We'll talk about why that's important to you. Chase, what companies are talking about today?
Yeah, so we're actually probably excited about this. Big car guy. We're going to look at Ferrari.
Yeah.
Some interesting news there on what's going on. The stock had a decent pullback here. Maybe there's a buying opportunity in this luxury car space. And then also, too, we'll look at Papa John's. Kind of opposite ends of the spectrum there, right? Right. And we'll also look at Salesforce and Eli Lilly. As always, break down the fundamentals, give you an idea if we think it's a buy, sell, or hold based off the numbers we see here.
Well, let's jump right into it. Talk, will gold hit $5,000 an ounce? With all the excitement surrounding the run up in gold this year, it seems to be, well, an easy target. Gosh, it blew through 3,000, blew through 4,000, maybe now 5,000. However, as investors pour money into precious metals such as gold, people have to remember that President Trump has pledged to stimulate the economy through tax cuts. That can be a negative for gold. The rise in gold has been due to investors that worry about the future of the dollar and other major currencies. Wall Street has labeled this the debasement trade.
And I did just want to say, I mean, we talk about gold, right? It's done so well. Year to date, it's up 52%.
Yeah.
I mean, it's just crazy. And then kind of talk about other commodities too. I was looking at silver. I think that was up something crazy, like 75%.
Platinum's up, I think.
I mean, it's just nuts. And gold actually was down a little bit on Friday, but silver was down 5%. So silver seems to be a lot more volatile than gold these days. But yeah, even after that pullback, silver's up. It looks like about 63% year to date. But kind of going back to what you were saying, I just kind of wanted to put those numbers out there because they have been so amazing. The dollar did decline in the first 6 months of 2025, but it has since stabilized. So again, these people talking about this debasement trade, well, we have a stabilizing dollar. Could be a little bit of concern for a reason of why to buy gold. And, you know, the interesting thing is we have just been seeing crazy inflows. I mean, September saw a record $33 billion invested in exchange-traded funds tied to physical gold. The excitement continues for gold buyers, but it is important to remember that normally during uncertain times, investors will find safety in dollar-denominated assets like treasuries that then can push up the dollar's value. The danger for gold investors is if the narrative shifts, gold could have a major decline.
Yeah, and the reason for that is that people won't invest in the dollar if the dollar is declining in value. But if it stabilizes and go up, that could change, and all of a sudden, the dollar is safe, and that's what happens a lot. But if you go back to history, go back 165 years to 1860, you will see that gold has other multi-year runs, but has occasionally had a major bust. Not occasionally, consistently. I want to say consistently, not occasionally, has had a major bust after these runs up. That means every single time it ran up, there was a bust afterwards. Investors in gold, well, should look at what happened back just as recent as 1979 with a major rally in gold, but 3.5 years later, all the gains, not some of them, all the gains accumulated had disappeared. Investors may want to take some of their profits because the higher gold climbs, the bigger the fall will be. In my view, well, $5,000 per ounce, while it's possible, but for gold, I got to say, it's a big gamble. And gold, we've said, and people say, well, you don't have it. You missed out. It's not what we do. We're conservative investors. We look for fundamentals. Gold is just a piece of metal that trades based on what the next person will pay for it. And it's just, congratulations if you have it. But when does it reach fully value? Who knows?
I just, people say we're maybe dumb, whatever you want to say.
Wait, we had to come like that on YouTube. Oh, you guys are dumb.
Yeah.
But okay.
And I look at it, and the thing you have to understand when you're investing, you have to have a why for investing in something. Because if you don't, as you said, things change over time. all of a sudden things start to flip. Let's say you're down now 10, 15, 20%, maybe 25, 30% even on gold. What do you do then? Why did you buy it? Well, it was safe. Well, being down 30% is not safe. Right. All of a sudden that flips. Now that fire starts to fuel itself and it goes lower and lower because people were buying it. Why? Because it was going up. And if you're buying something because it's going up, well, you sell it when it starts going down. And that, I think, is a big issue here for a lot of people buying gold. Again, congratulations if you've done well on it. But the big question is, will you get out?
Yeah, when to get out. And the thing, too, is that what happens? I've been doing this for 40 years. I've seen it not just on gold, but other things as well. Right now, I think it's around $4,200 an ounce. Drops down to maybe $3,800. Oh, this is a buying opportunity. I'll buy more. And then drops down to $3,500. Oh, buying opportunity. I get a little bit nervous, but I think I'll buy more. And then goes to $3,000. Oh, my gosh, now I've lost more money. I better sell everything. I mean, there's just no rhyme or reason why you buy these levels. You got to remember gold is based on what the next person will pay for it. You have no clue. And if somebody says, oh, I know where gold's going, they're lying. No one knows where it's going, not even nobody. It's just what the next person will pay for it.
Well, and we always talk about real estate, right? It's like, okay, well, what could you rent your house out for? Okay, then you can assign a multiple based off rents to get an idea of what that house is worth. Businesses, same things. You can look at EBITDA, you can look at profits, you can look at sales, and you can assign multiples to those different aspects of that business to come up with the value of it. What is gold actually worth? I don't know. As you said, whatever the next person will pay for it. Yep. And that's why we stay away from it, because there is no cash flow, there is no sales, there is no earnings, there's no way to fundamentally value what gold is worth. And it just drives me crazy when people say, oh, well, it's a kind of almost like a doomsday thing. We've talked about this before. A doomsday thing. I don't want a gold. What am I going to do? Throw a gold brick at somebody? Like, that's not going to do anything. Like,
well, you use it for trading, but what are you going to trade it for? I mean, it's just, So, and the other thing too, I read somewhere that actually jewelry stores are having a hard time because the price of jewelry, gold jewelry has gone way up. So their sales are dropping. So again, that's another reason gold goes up. People are going to buy less gold jewelry. Demand will fall.
Yeah, my wife, she likes gold, and I told her no gold for Christmas this year.
Yeah,
so.
Sorry. It's out. And I do say, I remember reading a long time ago as well, that there is a certain price, like we now have man-made diamonds, there's a certain price that they can make gold. And when that hits that price, there's going to be the end because it can't keep going. Is it 5,000, 10,000? I don't know, but there is a price. They can say, yes, we'll manufacture gold.
Well, the thing I always hear about is, the central banks around the world, they're buying gold. And I don't want to argue that. That is true.
I think it's true, yeah.
But what happens when that stops?
Yeah.
Right? If that's the reason why gold is going higher, I can't tell you how much more gold the central banks across the world will be buying. And they're not going to be like, we're going to be buying this amount of gold. There's not, again, a definitive plan there. So it gets very hard. It's a trading mechanism, essentially, of when to buy and sell gold, and that's not what we do.
Right. And again, if you have gold, made money, congratulations, but I think you have to come up with an exit plan. Some pick numbers, kind of like many times executives do. They pick numbers when they're going to sell their stock at, it's a plan, because you don't know where the top is. So I'd say if you have gold, congratulations, but you might want to have some type of plan to reduce your risk. So let's move on and talk about great news. Some great news here that more working class Americans than ever before are in the stock market. That does sound like good news, but when you dig a little bit deeper, it's rather scary. I mean, 54% of Americans with incomes between $30,000 and $80,000 have taxable investment accounts. There are several reasons for this, like no more commissions for trading stocks, those are gone. The excitement of investing on certain social media sites. I mean, gosh, some of these sites, they just rant and rave about stocks, and they're not good stocks. But
you have the whole Reddit movement.
There we go, yeah.
Wall Street bets, yeah.
They're out there. And it's so easy to trade stocks now. I mean, if you got a cell phone, it's right there in their hand. You can do it anytime that you want to. Like, oh, yeah, I'll just do a trade right now. I mean, so that's why there's so many people doing it.
Yeah, and it's kind of funny, right? There's an old saying out there that when your barber starts talking to you about stock tips, that is the peak of the market. And I go to a barber, and he always asks me for advice. He hasn't given me any hot stock tips.
Oh, wait till he starts giving you the tips.
Then I'll know we're in for something problematic. But it does seem that we kind of are in that space today. As you talk to so many different people, and they all have these stock tips, but no real concept of why they're investing in these things. And these investors have only been investing for probably the last 5 years and have not experienced really any long-lasting declines or turmoil in the markets. It's all been pretty rosy lately. And the thing I always look at is it just seems like anybody you talk to owns NVIDIA. And that is always something that scares me. I don't know anything about stocks, but I bought some in NVIDIA. It's like, it's a little troubling.
And again, we got to say, congratulations, you've done well. But, it's gone throughout history. I mean, in 1929, remember the 70s, then we had the tech boom and bust. It continues to happen. And many of these investors are simply trading stocks and don't understand the fundamentals of investing for the long term. Some of them have experienced very good returns. Again, congratulations. Not because of any specialized knowledge, but because of the luck of picking some high flyers that have done well for them in the short term. And they think they have something there. Again, I'm sorry. It's just luck. You have no specialized knowledge that, these are going to do great.
Yeah, and I mean, that's the big issue that I see with people is you kind of get this false sense of confidence, right? Because you're doing it and, you talk about maybe the S&P, right? And I'm beating the S&P. I'm making like 20, 30% per year, which is possible that, there's people out there that have picked the right high flyers for the last couple of years. I was talking to a friend's brother and he was like, this guy knows what he's doing. He got in on CoreWeave and now he's in on the quantum computing stocks and this guy knows. And I'm like, well, CoreWeave came out like, what, this year?
Yeah,
So
I think a few
he
months
knows,
ago,
right?
right?
And it's this thing that, these guys know because they made money.
Right.
And the issue is, you're right, the market can be so crazy for a short-term period that all of a sudden things flip. And it comes out these investors really didn't have an idea of what the earnings or the debt for the stocks that they were trading was, and it creates these problems. And they just continue to make money as they buy and sell. But I mean, it's just such a shame because, again, you can make so much money in the short term, but you can turn around, kind of like we talked about with gold, and lose everything.
Yeah.
If you keep on this risky path, you can lose everything. And it's just such a problem for young investors because, there's people at 25 to 45 years old maybe, they can make the big mistake of missing out of years of compounding. I mean, if you just make a decent return over a 40-year period, you're not going to fail.
No.
You're going to do very, very well. But the problem is people, they want to make that quick hit. And that is what keeps them coming back. And then all of a sudden that quick hit turns into complete failure.
I read something the other day, too, about this one investment manager. He's like in the top 3 for the long term. He's never been in the top for the short term. Because what happens, if you're in the top for the short term, you're many times on the bottom the next time. So he just, like we do, plod along, make the nice thing, because we are worried about where you'll be in 15, 20 years, because this is for retirement. Again, if you're gambling, having fun with it, fine, go ahead. You'll probably lose money. But it's the same thing, like I heard the same thing back in the tech boom. Like, and this guy's so great because he picked this one, he picked that one. I think it was a week or two ago we talked about how a lot of the companies that laid the fiber optics for the internet, they all went bankrupt. But over my 40 plus years of working in the investment industry, I've heard the same story many times and it never turns out well. When you try to help them understand how things really work in the investment world, they justify it with what they're doing with such statements as, well, Brent, you don't get it. This time it is different. I wish these young investors would understand that investing in stocks and earning a 10% annual return per year is very good. I mean, that's double what the safe return is, more than double the safe return of the 10-year treasury. I'm sure many who read this or hear these words I speak think I have no clue what they're doing and they have some specialized technique and this can't fail. You don't understand what I'm doing. I've got the secret.
We've heard that many times.
Many times.
And again, the thing that I think people miss is short term could be 5 years.
Yeah.
Short term could be 10 years. You could have a very successful trading career, I'm going to say, for 10 years. But that is short term because many times you should be investing for 40, 50, 60 years. Yeah. And again, you have a great 10-year period, but then you have a now next 10-year period where you lose everything. That's not good.
Not good at all.
So again, that's where that strategy and implementation of investing in good, sound businesses for the long term, which is, again, 20, 30, 40 years, is so much more valuable. Because when that day comes, I'm going to say that reckoning comes, when things do shift back to a more normalized period, again, which it will, these investors will be left with a small amount of capital and then not much time left to invest because they're now older and closer to retirement. Only then will they realize that their risky trading strategy proved to be nothing more than gambling. And I don't say I love to have this conversation, but it seems to be that I have this conversation more often with clients. They're like, well, my grandson's doing great, and he got into NVIDIA, and but it's good. He can take those kinds of risks. And I always ask people, I'm like, well, why can't you? Oh, my risk tolerance is low. Why is your risk tolerance low? I did this crazy thing back when I was younger. And it's so funny because this whole concept of risk tolerance and young people being able to take these high risks, the reason that people when they're older have lower risk tolerance is not necessarily because their appetite for good investments has changed. It's because they realize that doing risky things ultimately many times leads to you losing money. If everything was easy when it came to high risk, people would do it, but it doesn't pan out that way.
Yeah, the experience that they have is what actually happens, and that's why it's so important to understand this. And investing is for your lifetime. And you may think, well, yeah, I'm just short-term investor, but you will be investing for your entire life to grow your net worth. We talk about growing. We talk for our clients generational wealth to grow for the family and stuff. I mean, that's what you should be doing. And yeah, if you want to take a high flyer and buy a few shares of, the next hot quantum stock, whatever, I wouldn't do it because then you lose effective compounding. But you can do that. But just make sure what you're putting away on the safe side is growing, and maybe have fun time gambling. But actually, it's so easy now to gamble on sports. Just gamble on sports. You probably have the same odds.
Yeah, and then that even then pissed me off. I was just in Vegas this last week, and I lost $130.
What?
Gambling on the my sister-in-law's boyfriend talked me into doing a bet, and I was like, okay. And then I'm like, you know what? I'm 0 for 3 on these sports bets. Why do I do this? And it's like $100, right? Like you said, go gamble on a quantum stock. But why would I do that? Because I get pissed off when I lose the $100.
Yeah. I'd rather grow my money at 10% per year on average over the next 40 years than have this year we did 100%. Next year you lose 50, and then it takes 100% get back to break even. I mean, you get in these modes when you understand compounding, you understand investing. That's why you and I don't do it. We understand the game. And a lot of people think they have a whole different game they're playing. They're not.
You know why I think I get so angry when I lose money gambling? Because I look and I'm like, I knew I shouldn't have done it. Like, but there's that like what if scenario. And I think it's the same thing with stocks, right? If you buy something and it goes down 80% and you're like, I think it's so frustrating because I knew I shouldn't have done it.
Yeah.
And I think that's why you and we don't gamble on stocks, because we know better. And then it's like, I would just be so mad at myself if all of a sudden it goes down 90%. I'm like, I knew it. I knew that was a bad idea.
Well, and I used to love playing in Las Vegas, the $5 blackjack tables, because I could stay there for a while and not lose too much. Now you can't find anything under a $25 table.
I think you got to go to Old Vegas. I think they still have them there.
Yeah, but
maybe I haven't been.
Maybe, yeah. I like the nice hotels, so I'll just go to the shows. But let's talk about lower-end consumers are having a hard time making their car payments with the rising cost of cars and higher interest rates. Lower-end consumers are falling behind on their car payments, and the numbers are starting to get, a little bit scary. 14% of new cars that were sold to people had a credit score under 650. This is the highest percent going back 9 years to 2016.
Yeah, I mean, it looks like people are getting more in over their head as subprime loans that are 60 days or more overdue are at a record 6% this year. And I was blown away by this. The number of repossessed vehicles is also climbing to a record not seen in 16 years to an estimated 17.3 million repossessed vehicles.
That's a lot of vehicles. I saw that too. Like, wow, that's a lot.
Yeah, that's not good.
No.
Some consumers overbought a car probably due to a good salesperson and that new car smell that sometimes is hard to resist. I mean, it's very, I don't want to say easy to buy a new car because I bought that Suburban earlier this year and it's like, gosh, you're at the dealership for 3 hours and, it takes forever. And, actually we went, we looked at it, then we came back and we bought it. So, I mean, it probably took about 6-7 hours when you factor in all that time there. But, I mean, it is easy to get excited around the car. And I think that's the problem. And people, they fall victim to, it's just, X amount as a monthly payment. Right. Like, I think I can make that. And then it stacks on top of other things and creates problems down the road. But gosh, yeah, I just, I think this is an issue going forward. And I do wonder how it'll impact the used car market, though, because of all these cars getting repossessed, it might help with used car prices.
It very well could. And here's some more data. Some consumers are starting to regret their new car purchase, considering, I love this one, the average car payment now is around $750 per month, and 20% of loans and leases are now over $1,000 a month. I mean, that's a lot of money. If you're making $80,000 a year, which is pretty reasonable income, having a $750 month payment is pretty hard. We will continue to watch this indicator along with others to verify that we are only seeing a slowdown of growth in the economy rather than a decline economy. Big difference there. Slowdown in the economy versus decline economy. It's important to remember to be careful where you invest. And I was thinking that you were talking about the repossessions. Is there a company, public company, that does repossessions because their business is probably going up?
Yeah, maybe. I mean, I don't know if there's one out there, but hey, it could be beneficial.
I think it's always like Joe, the local guy,
Yeah,
that does repossessions.
But I mean, you got to point this out too. I mean, we've talked about a lot of the private market because the thing that we look at here is these subprime loans for cars ended up in private loan deals that were sold as low risk because of no market fluctuation. The problem here is we are starting to see write-downs from publicly traded banks for bad loans. And with private credit, you might not know there's a problem until it's too late, since they don't have to disclose the same info as these publicly traded companies. I mean, we saw JP Morgan, they took, I think it was like $130 million write-down because of Tricolor, I think it was. $130 million to JP Morgan is not problematic.
Yeah, they're talking trillions.
Yeah, we're talking trillions. They have trillions in assets, trillions in loans. $130 million doesn't really impact them. But the problem is on these private credits, they don't have to do these write-downs that you're seeing in the public space. So you won't know there's a problem until all of a sudden they're like, actually, we can't make that payment, that interest payment we told you we could because all these loans that we had are now problematic.
Yeah.
You're like, what do you mean? Oh, yeah, we didn't have to disclose we were having problems. I mean, there's some big issues, I think, if there is a continued slowdown here.
And I know you listened to the conference call from JP Morgan Chase as well, and Jamie Dimon and the CFO, I think it's Jeremy
Barnum.
Where Jeremy Barnum said, well, yeah, those guys that do the private, equity and loans, they're pretty smart guys. And Jimmy goes, yeah, but they're not all that smart.
And I love Jamie Dimon. He said, when you see one cockroach, there are probably more.
Oh, and that hit the mainstream media too. Everybody's talking about it because that means and Jamie Dimon's very well respected. He is very conservative. He's very cautious. But for him to say that was like, ooh, we need to be careful.
Well, and I just want to point out one more thing before we move on to Ferrari. I was reading earlier in the day, talking about these lending that is done to non-depository financial institutions. They're called NDFIs. This is mortgage companies, insurers, and private asset managers. I was blown away by this. But loans to NDFIs, I think because of the big push into private credit, have jumped by more than 50% year over year in 2025. So again, we're seeing in the public space, but we haven't gotten any news yet out of what's happening in the private market. And if things do start to slow or decline, I mean, you could be faced with some big, big issues in this private credit market.
And we always talk about the private equity, private credit. Is it a lack of liquidity, the high fees? But one thing we never mentioned, which you kind of realize now, is the lack of information, what's going on behind the scenes.
Yeah.
And all of a sudden you're hit with, well, how did they go bankrupt? How did they, Tricolor, how did that happen? Because you never get, like a public company, you get, this is going on and drives the stock down. But private companies, you never hear anything till like, yep, sorry, we're filing bankruptcy. Terrible. Again, if you don't know, you've not heard us for a while, we do never recommend investing in private equity, private real estate, or private debt. Stay away from it. You want to do some racing here?
Let's hit it.
Okay, let's race over to Ferrari, which that is their symbol, RACE, R-A-C-E. They're in the auto manufacturers industry. I have never seen this before. Short percentage of float, 5,000%.
I think it's because it's an ADR. If you look at the shares that are floated, it kind of distorts it since it's an American depository receipt.
I knew that was kind of something I'd be there. But the PE ratio for a Ferrari race is 38.7. That's well below the industry, 80.7. And that is the industry of manufacturers, auto manufacturers. I guess Tesla probably drives that way up with their PE ratio. Price of sales, 8.9 versus 1. Price to book value, 17.3 versus 1.8. Price to cash flow is 26.3 versus 11.6. They do have a PEG ratio going forward, which is pretty good, 1.2, but the valuation ratios look terrible. Now, they have grown their earnings over last year by 12.4%. The industry was down 39%. Sales for Ferrari up 7.6, also very good because the industry was down 5.3. The 5-year earnings per share growth estimate from the analysts, 36.2%. That's well above the industry decline of 31.3. Now, they do pay a dividend. I'm kind of surprised in this. I think they brought that out a little bit later. It's 0.9%, almost 1%. They do use 33.5% of the earnings to pay that out. And then the balance sheet, we do see the current ratio is 1.7, same as the industry. Debt to equity, no problem here, 0.9 versus 0.5. They do see, let's see, I was going to look at intangible assets, 24.9 versus 3.3. I figured there'd be a lot of intangible assets there. We do see a net profit margin, very good. I knew this, 22.9 versus 1.8. They have managed to keep the price of the cars up and their profits very high. Return on equity is very good, 45%. Return on invested capital, 24.5. Those are good numbers. But the free cash flow, not so good. It's about 1.6 billion. The industry is at $3 billion. So disappointed there on Ferrari.
Yeah, current price here for Ferrari, again, their ticker symbol Easy Race, RACE. It's $399.08, 52-week range. The low here is $372.31, and the high $519.10. So
They've had quite the pullback. Wow.
yeah, I mean, year to date, it is down about 7%, but I mean, this has been a great performer over the last 5 years, up 110. Over the last 10 years, up almost 600%, even with this recent pullback.
What time frame was that?
10 years.
I don't show them as a 10-year. I don't think they've been out for 10 years.
Might be then however long since they went public.
Yeah, I don't think they've been public for 10 years. Maybe I'm wrong. But, yeah.
It looks like they went public like end of 2015. So maybe yours isn't showing because it's not quite 10 years.
Not quite there yet. Yeah. Okay.
But anyways, going forward for this company, you go out to, let's see here, December 2026, estimated earnings per share, $12.14, gives you a target sale of 201.52. So, I mean, this thing still trades at 32 times future earnings. And I got to tell you, it tumbled because of their capital markets day this last week. I think it was down like 14%. The market did not like what it heard. And one thing I find interesting is they will be releasing about 20 new models over the next 5 years. I think this could cause problems for them. Number one, it's going to lose that exclusivity. Number two, I would have to imagine that would drive up costs, right? Because now if you're doing more customization, having different models, it's going to have to be different factories. There'd have to be more costs that go into it. I think this could be a big problem for Ferrari in terms of growing their earnings. And with a 32 times multiple, they're going to have good earnings growth.
And the thing, too, when you get a Ferrari, when you want to buy a Ferrari, you want to hear the sound of the engine. And same thing happened to Porsche. They have their EV. I forget the name of it, but
I think it's like the Taycan or something.
You can get one of those for half price because Porsche enthusiasts, Porsche owners do not want to get an electric car. And I think Ferrari's kind of the same thing. When you think of Ferrari, you don't think of an electric vehicle. You're not being practical. You're getting a sports car. I think that's going to cause Ferrari problems like it has for Porsche. Porsche you want a nice car?
Well, it did change. They said by 2030 they'd have about 40% be electric vehicles. Now at that Capital Markets Day, they said 20%. So they are kind of saying, maybe we are wrong. And we'll see what happens with their Electrica that comes out next year.
Yeah, we'll see exactly. All right, I'll take a break. When we come back, stay with us. You'll listen to the Smart Investing Show with Brent and Chase Wilsey. We'll be right back. Alrighty, welcome back to the Smart Investing Show. I forgot to promote the newsletter because there's so much information on the newsletter. It goes out every Friday at 5 o'clock by email. Sign up for it, it's free. But not a good time to be a Qualcomm shareholder is one of the topics, along with another sign of a slowing economy is the number of people quitting their jobs. AI does consume a lot of energy, but it can also reduce energy consumption as well. Understand that. Will Tesla ever be able to use their self-driving cars in the U.S.? I found some important information on that was very surprising. The excitement of drinking wine, well, that's going sour. And then will the new electric Ferrari be able to carry on the tradition? We'll talk more about that in the newsletter. It's all free at the website, smartinvesting2000.com. Again, smartinvesting2000.com. Every Friday, newsletter, free. Sign up for it. All right, let's talk about financial planning. For that, we turn to our financial planner, our CFP, Harrison Johnson. Harrison, how you doing?
Doing well, as always.
I like this, and you're the financial planner, but I've kind of talked about this many times before. I believe what you're going to talk about because I like how you say upgrade your emergency fund to an emergency plan. That's what people don't do. So explain what you're talking about.
Well, what kind of got me thinking about this is, with the federal shutdown, a lot of federal employees are, not receiving paychecks, even though they're still working. But there's things that come up where, if you get laid off from a job or if you're a federal employee and, not getting a paycheck coming in or you have unexpected expenses or whatever it is, a lot of people think that you need to have an emergency fund. And that's true, but I think it can go a step further because sometimes everybody needs cash no matter who you are, but sometimes you have too much cash, you might not have enough cash based on your situation. So I like to think of it as, contingency plans or layers that you have in place so you can go through a progression of where to access funds if you need it. So like the first place that people can get money is with a credit card, not to accrue interest, but purchases that you put on a credit card, as long as you're not keeping or carrying a balance, as long as you make those payments by the statement date, which is usually, over a month later, there's no interest on it. So that's the first place for, very short-term spending. Once you get to the point where you might accrue interest, then the next place you could look to is actual cash reserves, the traditional, emergency fund. Depending on your situation, 3 months of spending might be fine if your income is variable or you have a lot of expenses. You might need a little bit more. You might need closer to that 12-month number or whatever it is. But again, it's based on the situation. But I think a lot of people have too much cash, and then that means that they have cash that's not working for them in other ways. So for a lot of people, 2 to 3 months worth of expenses might be fine. That's actually in a liquid, money market fund, something that earns interest. T-bill money market funds are great because you don't have state taxes on them. But other than that, it's great to have credit lines set up, like a HELOC, or you can set up credit lines on investment accounts. So that's another source of capital that you can get if you were to need it. In many cases, they don't cost anything to set up. You only accrue interest if you're actually borrowing money. I always suggest to set them up before you need it, because sometimes they take a month or two to actually set up, especially on the HELOC side. But, you can kind of pair some actual cash with a credit line, and that way you don't need to keep as much cash. And then on top of that, if you have different types of investment accounts, you can access those. Taxable accounts don't have restrictions. Roth IRA contributions can always be withdrawn tax and penalty free for any reason. If you have an HSA, you can always reimburse yourself for prior expenses at any point. And also with retirement accounts, you have the 60-day rollover option, where if you withdraw money from a retirement account, as long as you replace it within 60 days, there's no taxes or penalties. So understanding, all of these different areas are places that you could potentially get cash, creates more of a plan, as opposed to just saying, well, I'm just going to have, 12 months of expenses in a savings account, for example.
And it's so important that you bring this up because, again, people do keep, I think, too much in cash, earning a very small amount. But you talk about this plan, which is great. I'll never forget my second year at junior college, John Keegan, the professor, he talked about you want to borrow money when you don't need it. Because when you need it, no one will give it to you. And that's one of the things you're talking about here. I mean, you've got to set up this plan. And you mentioned about the IRAs. You mentioned about, the HSAs. If you have a good financial planner that you're talking to, he sets this up for you. So you have this emergency plan. And I don't think these other financial planners that they sell you mutual funds or whatever, they're not thinking about stuff like this.
Well, I think you're probably right in that. And the other side of it is, we talked about the emergency part of this, but sometimes it's, something that you want to buy. Maybe, we get people that say, well, I want to buy this car, I want to buy this house, or I want to go on this vacation, or I want to buy this boat. Sometimes it's things that you want to do where if you don't have the right liquidity available, you can't execute that. So understanding, how all of these different things work and how they can be paired with each other and again, layered, it allows you to, protect yourself if an emergency does come up, but it also allows you to use the money that you have to do the things that you want to do when opportunities come up.
And I would just say there's a few things I wanted to kind of hit on is, number one, the credit cards, just to really reemphasize for people, what we're talking about here is it is like a maximum, like a 30-day-ish loan, depending on your statement balance.
As long as it's not accruing interest.
As long as it is not accruing
hit that home.
So,
we don't want to borrow at 25% or 30%.
So there's people like in the government shutdown situation right now, if you're not getting a paycheck, you're putting things on a credit card. Hopefully the shutdown ends before your statement balance comes due, and then it wouldn't be a problem because then you'd get back pay and pay it off.
Right.
The other thing, too, that I was thinking about while you were speaking is, you think about people maybe having too much cash, and they're like, I don't want to tap a HELOC. But let's just use like a 5-year period for an example. If you're not earning interest on your cash, your money, because you have too much cash for a 5-year period, that costs you more than maybe tapping a HELOC for 3 months.
If you were to need it with the opportunity cost of what that could
if
grow.
you look at the opportunity cost. So that's kind of what I look at is like, oh, no, I don't want any debt. Well, it's like, well, I mean, if you're not investing money and it's just sitting there in cash, you're right. I mean, yeah, you need to have an emergency plan, but you could actually be costing yourself more money. And I'll tell you, to tap the HELOC is not going to feel good, obviously.
Right.
But long term, it may have actually cost you more money to keep too much in cash.
They're really not bad. I mean, I have a HELOC on my house. I set it up just to have it because I wanted it. My interest rate is 5.74%, and that's
a
again
HELOC?
on a HELOC. Yeah,
Who's that with?
My Point Credit Union.
Oh wow, that's a great rate. That's the
Yeah,
best.
it cost me nothing to set up. They did like a drive-by appraisal. I wasn't even there. They just did it. and
drive-by shooting.
No. Well, that's what they call it because they don't come inside and actually take pictures.
Hey,
and
I'm
stuff,
shooting a drive-by later. Oh, geez.
but I was like, yeah, I mean, I've got some equity in my house. I'll set this up, and now, I've got a $150,000 credit line there, and 5.74% interest is not bad at all.
And that's only if you need it.
That's
You
only
pay
if you need
nothing.
it. So if I needed to withdraw $5,000, I could do that, and I would accrue the interest on that $5,000 until I paid it back or whatever it is. But they're great tools, and I think a lot of people just don't like the debt part of it. But in many cases, if it's just for short-term little bridge loans where you need some money, it's a great place to do it. The other thing that I see is people will have those accounts set up with a balance on them, but then they also have like $30,000 in a checking account. If you have a credit line with a balance, you don't need to also have that money in a checking account. You can just pay it off. Don't pay interest if you don't need to. That's kind of the benefit of having those credit lines is you don't need to have then as much cash. But if you do have the cash, yeah, pay it off.
Yeah, the S blocks, the security-backed line of credits. Yeah,
That's another one, yeah. So, I mean, those have been more popular, and there's different nuances in that. But those can be set up even quicker, and in many cases, depending on your account balance, the interest rate could be even less than HELOCs. So,
emergency plan, great idea. It's how you can really be smart with your money and still have your investments earn more for you.
well, that's what it comes down to. You want your money to grow. You need a plan to, access your money without costing yourself due to, market volatility and things like that. But having the right plan in place means that more of your money can be invested in working for you without hurting you if something bad does come along.
So we'll get away from the term emergency fund. I like the emergency plan. It's much better.
Yeah.
Right. Once again, great information.
Thanks, guys.
Harrison. All right. Again, that's Harrison Johnson. He is our financial planner. He is a CFP at Wilsey Asset Management. If you want a free consultation with him or talk to him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. All right, Chase, ready for another company?
Let's do it.
Let's talk pizza. You want to talk pizza?
Let's talk about some pizza.
Let's talk about Papa John's International. I don't think I've eaten there, not very much. I usually just think of Pizza Hut, but let's see.
You go Pizza Hut? I always think of Domino's.
Oh, Domino's. I'm sorry. I meant Domino's.
I was
not
like,
Pizza Hut.
I've eaten at a Papa John's more recently than Pizza Hut.
Pizza. Yeah, I'm sorry. I meant Domino's. But let's look at Papa John's International. Their symbol is PZZA. They're in the restaurant industry. Not a good start. 18.1% short on the stock here. That's pretty high. We do see a P/E ratio, which means they have earnings 22.8. That is below the industry at 29.8, but still kind of high. Price of sales looks good, 0.8 versus 2.4. Unfortunately, no price to book value, which means their liabilities exceed their assets. We don't like seeing that. Price of cash flow, but they could be a franchise. I think they are a franchise. Yep, there we go. That's a problem. Price of cash flow is 13 versus 16.6. That's a positive. PEG ratio, very good, 1.9 versus 43.4. Now, unfortunately, their earnings over the last year, they're down 21.1%. Industry up 1.8. Sales for Papa John's, they are down 0.7%. The industry up 3.4%. The analysts going out 5 years, they see something here because they say their earnings are going to go up 14.9% over the next 5 years compared to the industry growth of 2.7%. They do pay a nice dividend. I like this, 3.5%. They use 80.4% their earnings to pay that out. A little bit on the high side, but I think still sustainable. If you look at the cash flow of the company, we do see that, let's see, the dividend payout ratio for the free cash flow is 107, so that's a little bit high. Let's look at the balance sheet. We got a current ratio of 0.8 versus 1.2. No debt to equity because there is no equity. Again, we talk about the franchise issue there. We do see a net profit margin 3.6. That's about half the industry at 7.9. Return on equity a negative 17.4. Don't like seeing that. Again, has to do with the situation with the franchise. Free cash flow not very good. It's 57. I believe this would be 57,000, maybe 57 million. but the industry's at $3 billion. So that kind of, I'm not liking seeing that. I would like to see more free cash flow from the company. What do you got, Chase?
Absolutely. Current price for Papa John's, again, their ticker symbol, I think it's a creative one, pizza, PZZA again. Current price, again, $52.01. 52-week range, I mean, the low here is $30.16 and the high $60.75. The returns for the stock, this year so far have been good. They're up about 27%. But you look over the last 5 years, you're down about 32%. Last 10 years, you're down about 25%. That is not inclusive of dividends, so you may have done a little bit better with the dividends. But I look back at 2021, I was kind of blown away by this. The stock was trading, it looks like around $135, $140 a share.
Wow, that was probably time to get out.
Yeah, in hindsight, definitely was. Looking forward for this company, though, a little disappointed. Go out to December 2026. Estimated earnings per share here, $2.22. We get a target sell price at that level of $36.85. Forward PEs now around 23, 24 times. Now, I'll tell you, I was a little bit hopeful on this. I thought there might be a little bit of an arbitrage situation with Papa John's because came out this past week, the stock popped on the news that, what is the name of the firm here? Apollo Global Management supposedly implemented a new bid or offered a new bid to take Papa John's private at $64 a share, which would be about 25-ish% above the current level.
And the problem, because we've done some arbitrage before, but the thing you have to remember if you're doing that, Apollo Group, I think you said is going to buy 20% more or whatever. That is great, but you have to realize that deal may not go through. If it doesn't go through, you don't want to be left with a junk company. You've got to make sure if you're going to do this arbitrage situation, you're investing in a good company that if it doesn't go through, hey, I'm fine. I still got a great business here. Good price.
Yeah, and I do think the odds of a deal like this going through is decently high. I mean, I don't know how far along in the process they are is the only problem, but they're not really a competitor that's going to maybe run into issues with the regulators about lack of competition.
Plenty of pizza places around.
Plenty of pizza places. So I don't think that would be an issue. I did look up too, because I know obviously the founder, John Schnatter, who
I thought it was
Papa John.
I thought it was John Pizza. I guess not.
But I was curious because sometimes the owner of that company could derail it if they have too much in voting stock. I'll tell you, we went through this where we actually had a company that had a buyout that I think was more favorable for shareholders, but didn't come to fruition because the owner of the stock had voting rights and they were able to kind of do things that I think were wrong. But it looks like he's only got about 5.7% of the shares outstanding. So I don't think there'd be many roadblocks. If Apollo actually wants this, I think it will go through. It is kind of interesting. Papa John, he did... I don't think he goes by Papa John. Maybe he does. But in 2019, it looks like he owned about 31% of the company. So he got out. he did very well.
116, he probably sold that, got out with that stock then. So, but
yeah, you're so right. You don't want to buy a company, especially with upside of, 20%.
Yeah.
There, I think, is much more downside to that if the deal doesn't go through than getting a 20% gain.
Yeah. And you could be left with something that's not very good. So.
And actually, I misspoke, and he actually maybe didn't sell at a great time. Depends when he did get out, because 2019 the stock was around $50 a share. But if he sold again in 21, he probably did very well.
That's true. So, unfortunately, nothing there for Papa John's Pizza. We thought, again, with the arbitrage, might be a good thing for you, but sorry, not worth doing there. Let's move on to a company that's been in the news a lot lately, and then we're talking about Salesforce. Their symbol is CRM in the software application industry. Not much short here, 1.9%, 83% institutional owned. We do see it. They do have a pretty good comparative PE ratio of 35.3. The industry is at 53.9. Price of sales 6 versus 6.4. Price of book value 3.8 versus 6.8. That's a positive. Price of cash flow 17.9 versus 30.1, and they have a PEG ratio of 2.2 versus 5.9. So that's pretty positive. Now, over the last year, they are up on their earnings. Their earnings grew by 19.9%. The industry is only up 13.9. Sales climbed by 8.3, double the industry at 4.2. And the 5-year earnings per share growth estimate from the analyst is 9.6. The industry actually gets a better estimate of 13.3. They do pay a small dividend of 0.7%. They use 23.5% of their earnings to pay that out, so that's a little bit high for that low of a dividend. Taking a look at the balance sheet, current ratio 1.1 versus 1.7. That's okay. Debt to equity, they've done this growth that they've had over the number of years with very little debt. Their debt to equity is only 0.2, below the industry at 0.5. I will say they've got a lot of intangible assets on their balance sheet, 56.5% versus 34. Problem with that, those intangible assets could be written down, which does hurt the balance sheet. We do see a net profit margin of 16.9. That is above the industry at 12.5. Return on equity 10.9. Not very good. The industry is 18.9. Free cash flow, wow, this is something worth noting. $12.5 billion. The industry's at $3 billion. So they're doing some great things, generating some free cash flow. That's nice to see that. Chase, what do you got?
Yeah, so looking at the current price here for Salesforce, we're looking at, it's loading, $243.08. 52-week range, I mean, the low here, $226.48, and the high, $369. So definitely closer to that 52-week low than the high. You see the year-to-date return is actually down about 27%, considering an up market.
That surprises me because I thought they had all this great news, and I think Oracle was part of it, and the AI and everything. I'm surprised they're down nearly, what do you say, 26% year-to-date? I'm surprised.
I mean, it's called SaaS, or software as a service. I just think it's been hated, right?
Really?
So, I mean, if you look at, like we looked at, I think, in Adobe hasn't done well either. So these software companies that got so hot, I think they became overpriced, and now people are like, oh, no, AI is the new hot thing, but Salesforce is trying to put itself in the AI conversation. It just doesn't seem like people are respecting it.
People aren't buying it. Like, no, you're not an AI.
I mean, because the 5-year return here on it is actually a negative 5%. So you've actually lost money now over the last 5 years. 10-year return, though, up 213%. I've talked about this before, so imagine that, right? Your first 5 years, you're like, I'm a genius. I'm up 200%. But then your next 5 years, you made no money. And you're still 10 years, not bad. But the problem is for people that bought it after the run-up, they made no money.
Right.
Now, going forward for Salesforce, this is where, as kind of said, things got pretty crazy with this space, because you still go out to January 2027, $12.70 is the estimated earnings per share. It gives a target sell of $210.82. Still trades near 19, 20 times future earnings, even with lackluster performance.
Yeah, and I'm not seeing much on the earnings here. They seems to be a little bit wide. 1137 is the low, 13.9 is the high. But I think that's some other news, too, that they're projecting out. They took a bump because of projecting out 5 years or something crazy.
Yeah, I thought this was interesting, right? They had their investor day, and they actually said that they expect revenue above $60 billion in 2030. And analysts had polled by LSG had penciled in $58.37 billion. I'm like, geez, going out pretty far there. Like, that's something that I don't know why anybody would really, I don't want to say take that target seriously, but it's just so far out that you can't expect that number to come to fruition. I mean, we talk about the advent of ChatGPT and Anthropic and all these other players. That wasn't really around 5 years ago to the magnitude it is today. I don't know what it's going to be like 5 years from now. I think that is just way too hard to predict out. I mean, the stock went up a little bit on the news, but obviously it's didn't hold very strongly. Yeah,
and I looked at the balance sheet that the revenue in 2024 was only $37 billion. So that's almost a double. That's about 20% per year growth in revenue. That's just a little bit too over the top for me. And I'm surprised they say stuff like that, because I guess it's legal, but I think it could cause some problems down the road with lawsuits.
Those Matthew McConaughey ads, they better pay off, because I mean that's a lot of growth. And I know the big thing that they have was just the CRM system, but I'm not super familiar. They call it like Agent Force. It's their AI product. I don't know how they're planning on making money off of that and how that compares to a ChatGPT. And, the whole AI space is still kind of being formed and created. How is Salesforce expecting to, again, increase revenue by that amount? I think Agent Force is a large part of it. But are they relying too much on that? I'm not sure. Because the CRM system, I can't imagine they're going to have, so many new people sign up for that.
Yeah, and I have to say that in the next 5 years, there's going to be a recession of some type. I mean, you just have those in the economy, and that's going to throw their revenue, obviously, down the toilet for a while. So I'm going to say, and I probably shouldn't say this, but I will be like Jamie Dimon, I think it's irresponsible to come out with that number. You're just trying to hype the stock.
Yeah, I mean, I think it's true, because as you said, you have your sector-specific headwinds, you have your company-specific headwinds, but then you have your macroeconomic headwinds as well. I mean, 5 years, a lot can change, again, in the macroeconomy, in the sector, and for the company. So I think that's just, I don't give much credence to that estimate.
No, but obviously some people did. Stock went up. Yeah. So I guess that's why they did it. All right, let's move on to a drug company. We'll talk about this little company called Eli Lilly. That's been in the news probably the last few years here. Their symbol's LLY. They are a drug manufacturer. Not much short on the float here, about 1%, 84% institutional owned. PE ratio, 52.4, double the industry at 24.7. Price of sales, 13.6 versus 4.3. Price of book value, 39.4 versus, 5.8. And then price of cash flow, 66.2 versus 15.9. Can we say that this company is extremely overvalued in valuation ratios? I mean, it's just ridiculous. However, they have delivered because of the GLP-1 drugs that they have, and I forget the name of their drug. But their earnings over the last year were up 64.9%. The industry was up 43.3%. Sales for the last 1 year for Eli Lilly were up 30.3% versus 11.7%. But listen to this, the 5-year growth rate from the analysts, they think this is over, which I wonder too. Competition comes in, prices come down. 5-year estimated growth from the analysts is a negative 182. So you should not be buying their stock based on that. The whole industry is down 53.3%. They pay a small dividend, 0.8%, and they use 37% of their earnings to pay that out. That's pretty high. We do see that on the balance sheet, they got a current ratio of 1.3, same as the industry. Their debt, surprisingly, with all this money they've been bringing in, is kind of high, 2.2 versus 1.3. Net profit margin, very good, 25.9 versus 17.4. Return on equity, 75.5. That's double the industry at 33.8. And free cash flow, I'm going to tell you, the industry is at $9.8 billion. I don't know how this is going on here, but the free cash flow for Eli Lilly, a negative 50. So I think it's a negative 50,000. So we'll call it break even. They have no free cash flow coming in. I'm not sure why.
It might be CapEx. I know that they're investing a lot in factories and stuff. So if they're building out factories, that's one thing with free cash flows. It can change a lot.
Yep.
Because if you're doing all of these capital expenditures, I mean, they're going to be there maybe 1-2 years and then they fall off and all of a sudden your free cash flow looks great. So, but again, it's something you'd have to understand.
Yeah, it's kind of tough for a business because you want to invest in the future. You want to spend that money because you want it to keep going. But when you spend too much and things slow down, competition comes in. Now, I'm assuming they probably have a lot of debt. I'll check the balance sheet while you're doing that with your thing here, but I bet you they have a lot of debt now, too.
Yeah, well, let's look at the current price here for Eli Lilly. It's $802.83. Again, their ticker symbol, LLY. 52-week range, though, the low, $623.78, and the high, $935.63. Year-to-date, the stock's done okay. It's up about 4%. Over the last 5 years, though, it's done tremendously well, up about 462%. Over the last 10 years, up 946%. But as you said, valuations just don't look very good for this company. You go out to December 2026, estimated earnings per share here, $30.37. You get a target sell of just $504.14. It's trading about 26, 27 times those future earnings. And, I mean, the big thing you look at with these weight loss drugs is I still don't understand how much more growth can be achieved at these high profit margins for these companies. I mean, there is going to be competition, as you said, that comes in, and maybe the space continues to grow, but I don't think the margins that these companies make off the drugs will continue to grow. And you actually did see the Trump administration come out this past week. Looks like Dr. Oz, who's the administrator of the Centers for Medicare and Medicaid Services, noted that the price of the popular GLP-1 medications had not yet been negotiated by the White House, but Trump did suggest that obesity drugs, he calls them the fat loss drugs, could be much lower. Right. So they're putting pressure on them. They think they're overpriced. And I was kind of surprised by this. I did look this up real quick. I was like, people talk about, Eli Lilly's got other things besides just the weight loss drugs. But it looks like Mounjaro and Zepbound, which are the two drugs that they sell in the most recent quarter, had about $8.58 billion worth of revenue. Their total revenue is about $15.56 billion. So over half of their sales is now coming from these GLP-1 drugs.
Right. And if you have competition coming in, you get the government pressing down on prices. They do have a lot of debt, $34 billion in debt, long-term debt, and their equity is only $18 billion. So, I mean, you've got to invest in the future, but it's just something that, and again, everybody's trying to get the weight loss drugs. Competition. I saw something, Roe, another company, they're selling them, Hims. Everybody's selling these weight loss drugs. I don't know how they're doing them so cheap, but competition is very stiff in this. And I think it'll get stiffer as it goes on. And then if you've got the government coming in saying, yeah, you're overcharging for those drugs, you got to cut it. Eli Lilly could drop. What was their stock price? I mean, I think
$802.83.
Yeah, still pretty high.
I mean, and again, if you're priced at 27 times those future earnings, you're priced for a nice growth rate. So again, things change as we talked about. That's where that multiple gets pressured and that stock has big issues.
Exactly. All right. Well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If I'd discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. While there, you can sign up for that free newsletter. A lot of great educational information there as well. So also, you can listen by podcast too if you missed a part of the show. All right, thanks for listening. We'll be back next week right here on the Smart Investing Show.